key audit matter, which is designed by IAASB, and critical audit matter, which is designed by PCAOB, shares the similarity in their framework when it comes to relating with material issues in their financial statements. Similarities can also be found in the underlying criteria regarding matters to be communicated. CAM and KAM and CAM are communicated in relation to current period. When it comes to communicating in the auditor's report, the requirements and guidance are similar, such as what the matter is considered to be material and how it is identified as CAM and KAM, and how the matter has been disclosed in the audit report, and the type of information that has to be communicated. When it comes to communicating the qualified opinion, communication of KAM and CAM is essential. ISA 701 clearly describes that when there is adverse opinion, KAM has to be disclosed. However, there is no such requirement for CAM during certain situations. For both KAM and CAM, it cannot be set as an alternative for a modified opinion. The auditor has to clearly describe the reasons for modified opinion or the departure from an unmodified opinion.
According to ISA 71 and 260, an entity's governance should be informed of the auditor's views regarding significant qualitative aspects, such as critical accounting estimates made by the management. However, whether the auditor will find these estimates as areas of significant risk will depend on the following two factors. First one, whether these estimates are of high estimation uncertainty and they require significant judgment both on management and auditors' parts. If these two criteria are met, auditors are most likely to identify these areas as key audit matters. They also require to clarify the reason for which they chose this to be significant, and also say how this issue was addressed in their audit report. This will reduce information asymmetry between the readers and the auditors.
Is KAM related to every significant risk identified by the auditor? KAM are those matters that are most significant in the auditor's judgment in the audit of financial reports. Whether significant risks are key audit matter, the auditor will consider the significant risks that have been identified in the context of the company rather than following any particular standard that says that these are the things that has to be in the key audit matter. ISA 701 includes a judgment-based decision-making criteria to help auditors decide which are the key audit matters to be focused. In particular, they should consider areas where there is a chance of higher risk of material misstatement, or there is a problem in the management where auditor judgment is required.
Audit procedure depends on internal control and on those audit plans which are influenced by internal control. ISA 265 states that any deficiency or discrepancy in internal control needs to be communicated to the entity's governance. However, the auditor is not required by standard to report about these deficiencies externally. The identification of these deficiencies is more likely to affect the auditor's determination of key audit matters. The reason why the disclosure of these deficiencies in internal control is not mandatory is because these are considered to be sensitive in nature. But if the auditors consider that such issues are significant enough to disclose, they must explain why these are considered to be significant.
There are four common key audit matters. The first is impairment of assets. This means asset value are overstated in balance sheet. We should write down the value in account to the market price. The second is tax. There is always dispute between tax authorities and company in tax, so it's often require significant auditor attention. The third is goodwill impairment. It requires flexible impairment tests and highly accounting judgment, so auditor need to use the assistance of valuation expert to help them evaluate. The last one is fraud in revenue recognition. Improper revenue recognition could be recording fictitious revenue and recognizing revenue in earlier stages. The possibility of this is generally presumed on audit.
On AS 701, paragraph A53, it is rare that the auditor determine KM, but at least one key audit matter is not communicated with those charged with governance. An entity may have a very limited operation. An auditor may determine in accordance with paragraph 10 that there are no key audit matters. If no KM is found, then no communication of KM is required. Few scenarios when it is not appropriate to communicate KM in auditor's report, according to AS 701 paragraph 14b. For example, law or regulations prevent public disclosure about the matter, or there are adverse consequences of communicating matter as it is expected to outweigh public interest. However, this will not be applicable if the entity has publicly disclosed about the information. So apart from this, there are very limited situations when KM won't be communicated. However, KM section will be given in the auditor's report, and the auditor shall include a statement to this effect in the auditor report. Thank you. That's the end of our presentation.